And welcome to Sectors Up Close. I'm Angeline Ong. Our focus today is on the airline industry, and our guest is Philip Baggaley, the lead airlines analyst at S&P Global Ratings. Now, while the outlook for the global airlines industry is improving, the situation is far from uplifting. According to the latest forecast by the International Air Transport Association, global traffic this year will reach only 43% of pre-crisis levels. IATA also predicts industry losses of $47.7 billion, albeit a vast improvement over last year's losses of $126 billion. And although the situation is improving, the recovery is multi-speed. Large domestic markets led by the US and China are taking off, while Europe remains mostly grounded. For example, this index tracks only US airlines. It's up 25% this year, or more than double indices that track the global industry. Now, for more on this, I'm now joined by S&P Global Ratings Philip Baggaley. Philip, thank you so much for joining us. Everyone knows the airline industry has been ravaged by the pandemic, but how long-term is this damage? What's your view?
Well, we see two significant items here. The biggest long-term damage is all the debt that the airlines have taken on to survive the crisis. Half of all that government aid they got was in the form of debt, and the airlines borrowed a lot in the capital markets too. Adjusted debt, net of cash, went up about 1/3 in 2020 from $86 billion to $114 billion for the 9 big US airlines that we rate. So it'll take years, likely into 2023, 2024, before credit measures return to pre-pandemic levels. The other long-term damage, at least potentially, is how much business travel is lost permanently to video conferencing. Most business travel is for sales or client relationship purposes, and we do think that that will come back. If your competitor is going out to shake the hands and so forth, you'll want to be doing the same. But business travel for internal company visits will likely see significant erosion. Just how much will be important because business travel is more profitable for airlines than leisure travel.
Right, so business travel and debt. What other risks to recovery are out there, and how much will the fight against climate change hobble this industry?
Well, first thing that's happening is that the airlines will eventually be getting off the federal aid. That's going to be a big change, but fortunately, they're narrowing their cash losses pretty quickly. So they should be able to come off the ventilator and recover on their own. In terms of the long-term challenge, the environmental one is quite significant, really. Currently, there's a UN-sponsored treaty that covers a lot of international routes, but it's not difficult to meet, at least until later this decade. The underlying problem is that global air traffic is growing faster than improvements in fuel efficiency. So total CO2 emitted is still increasing, even though the airlines are buying new, more fuel-efficient planes. It's different than for autos, where there are big improvements to be made. Aircraft are already quite efficient, really, because airlines have wanted to reduce costs. So they need a technological breakthrough eventually, more likely in biofuels than electric, which is very hard to make work on larger planes or longer routes.
So, Philip, which airlines in which regions do you think will perform better than their peers?
Well, as you mentioned in the introduction, the US and China domestic are doing better than a lot of other regions, in particular Europe. Generally, we think that the airlines that should recover the fastest are those that serve domestic markets and focus on leisure travel. Think Southwest, Spirit Airlines, others like those. The big hub and spoke airlines like American, Delta, and United will take longer to come back, even though even they are about 2/3 domestic traffic. European airlines are being hit much harder this year because there's very little air traffic there, which is truly domestic. It all goes between countries. So even a low-cost carrier like Ryanair is almost entirely international travel. Now, international is not a total loss. Some big airlines think that because of the bankruptcies and retirement of older big aircraft, the balance of supply and demand will be more favorable for the airlines, not necessarily for the passengers, but for the airlines with higher fares. Still, higher fares tend to attract new competition, so long term, we're not sure that balance would continue.
Philip, grateful for your time. That was Philip Baggaley, lead airlines analyst at S&P Global Ratings. Now, before I go, here are some of the top stories in the sector, starting with earnings from two of the biggest US carriers. American Airlines reported a smaller quarterly loss as rising vaccination rates prompted a resurgence in domestic travel. American said it reduced its cash burn rate to around $27 million a day from $30 million a day the previous quarter, as it posted a quarterly loss of $1.2 billion. Meanwhile, Southwest Airlines posted a smaller than expected loss and also forecast lower cash burn as Americans return to the skies. It sees a cash burn of $2 million per day, as reported a loss of $1 billion. Hong Kong's Cathay Pacific will close its Canadian pilot base and has proposed closing bases in Australia and New Zealand. Cathay has already closed overseas cabin crew bases and shut its regional airline Cathay Dragon to preserve cash. The remaining Hong Kong-based pilots and cabin crew had to agree to permanent pay cuts to keep their jobs. Nearly 60% of Cathay's 2020 revenue was from cargo, up from 20% in 2019. And British Airways owner IAG says it will power 10% of its flights with sustainable aviation fuel by 2030. It pledged to buy 1 million tonnes of sustainable jet fuel per year. Now, it produces up to 70% less carbon than fossil fuels and offers airlines a way to become greener before hybrid electric or hydrogen options become available from the late 2030s. And that is your roundup of the airline sector. I'm Angeline Ong, and this is Reuters.